Hedge funds are where billionaires park their money. But what if you could invest just like them? In today's video, I'm going to be talking about the top 3 hedge funds that I would put my own money into and what that means for you. Let's dive in. I would really love if you could like and subscribe to my channel for this video. All right, so let's actually check out what are hedge funds. Oftentimes, people hear this sexy word, right? Hedge fund. What actually is it? And I think there's a lot of mystery surrounding this word, hedge fund. So, what does it actually mean? The word hedge actually means to protect. So, a hedge fund essentially is protecting your money. So, people use the word hedge like I'm trying to hedge my bets, meaning, for example, let's say you bet on football team A and, A is playing against B. Some people would put maybe, 50% of their money into A, and some people are putting also 50% of their money on team B. They're hedging their bets, right? So if A doesn't win, they're still making a little bit of a return by B because they hedge their bets. Some of their money is in team B versus if they put 100% of their money on team A and 0% of their money on team B, that's not hedging their bets. They're full on. All their eggs are in one basket. That is not what a hedge fund does. Okay, so that's roughly what hedge funds mean. So what actually are hedge funds? Very large overview. First of all, investors. So it's multiple investors, right? And typically hedge funds are what people call institutional. So if a hedge fund is institutional, that means it's actually more businesses that are investing in hedge funds. It, of course, could also mean retail. So a retail hedge fund is when you would have individual people like you and me invest in a hedge fund. And I'll kind of share when each scenario would be appropriate. But for the most part, let's just assume that they're institutional. So it's more of an institutional investor. You have big companies like pension plans, sovereign wealth funds, et cetera, investing in hedge funds in some of them. But so what is the point? The point is that a lot of people pool their money. So it's not just one person that's giving like, I don't know, $100,000 to a hedge fund to invest. It's like 100 people or more, 1,000 people putting $100,000 into a hedge fund. The hedge fund then gets this gigantic lump sum of money, and then they're trying to find companies and alternative investments mainly to put this gigantic sum of money into, hedge their bets, right? So they have multiple assets to hedge their bets, and that is how a hedge fund really develops. And they have multiple funds as well, right? So this moves on to point number 2. This is all private management. So a hedge fund is really a professionally managed company. There's many different hedge funds, but within one hedge fund, right? So let's say this here is one hedge fund. The hedge fund has multiple funds, which we'll get into. You might have fund A, and that they put some money of the investors into fund A. Then they might have fund B and so on. And each fund generally has something called an open date. So when the fund actually opens up and investors can say like, hey, I want my money to go into solely fund B. Or some investors might be like, hey, put my money wherever you can. I want to make money wherever. So put my money across both funds A and B. So you have something called an open date where the money flows in, and then you typically have a close date where the fund actually exits the investment. So the hedge fund might, for example, sell their investments after like 5 years or 10 years or whatever the holding period is. And then once they sell, presumably you'd make a profit, and that profit would be paid back to the original investors here. That's the hope, at least. So that's roughly a hedge fund. Now, of course, it sounds very complicated, right? There's a lot of private management, which means there's a lot of fees involved. And we'll get to the fees in a second. So again, this entire thing, this scale, shows you're reducing risk, which again means the same thing as the word hedge. It's actually a verb, to hedge. You hedge your bets, you hedge your risk. That's what a hedge fund does, but typically, again, through alternative assets. And then finally, you have, in general, higher returns, but that is not always true. And we'll actually get into why this is not always true. And believe it or not, it's not because hedge funds have poor investments. It's actually more because hedge funds, going back to the fees piece, they can be pretty expensive. And the fees, oftentimes, they take away, so they take away from the profit, okay? So that's why if you think back to a couple of videos, we talked about the top ETFs, and we're trying to find the lowest expense ratio. Why are we trying to find the lowest expense ratios? Because the higher the expense ratio, which is the same thing as a fee, the more it eats into your profit. So that's the downside of hedge funds. The fees are really high. So another couple of key characteristics of hedge funds here is, first of all, lower regulation. So they're actually not that heavily regulated like stocks or bonds, for instance. Hedge funds actually have lower regulation, which could be good because you can add more alternative assets, etc. But it could also be bad because there's less transparency. And sometimes investors don't necessarily know what's going on in their hedge funds, if you know what I mean. There's also a pretty high barrier to entry. So that means it just costs a ton of money to actually get into the land of the hedge funds. It's pretty high and it's pretty exclusive, so it's not really for retail investors, not for the everyday investor. And again, I'll get into what the retail investor means and what the institutional or what the potential hedge fund investor would have to do and how much they'd have to earn. Alternative investments, I already spoke about that. This could be anything from like shipyards to like something to do with space technology or things of that nature. So we're talking alternative though, which also means an increase in risk. Seeks to lower market risk. So why? Again, it's because of the word hedge. So it's trying to, for example, if there's geopolitical volatility, a hedge fund might invest in, I don't know, weapons manufacturer, for example. Again, it might not align with your views, but that's generally what a hedge fund does. They're trying to find ways to figure out, okay, what's going on in the world right now? What's going in the markets on, like what's going on right now in the financial markets and the economy, and how can we hedge that? If there's geopolitical activity, how can we make sure that our investors' money can make as much of a return as possible? So there's a lot of data going into this. And then it might use derivatives. Derivatives, they're a little bit more complicated. They're kind of like alternative assets. I'm not going to get into this, but again, it does show that this is more of a form of alts, right? So alternative assets. So these are some key characteristics of what hedge funds actually are. But the key points that I want you to take away here is that they are actively managed, which means the fees are a lot higher typically. You got high minimums, right? So this relates to the high barrier to entry. And then finally, we have light SEC oversight. So this is the Securities Exchange Commission, which essentially oversees a lot of the stocks aspects. So if you invest in the stock market, generally speaking, that is part of the SEC's oversight. They're really focused on rules and regulations, making sure there's a lot of disclosure going on in the stock market so investors don't get hurt basically. So they ensure transparency. Because there's light SEC oversight for hedge funds, like I said before, there's a little bit less transparency, which could be good or bad. Typically, it's not always the best, especially if you are a retail investor. So who can actually invest? So this gets into the institutional versus retail versus accredited investor. So who can invest in hedge funds? So from an institutional perspective, I'll start over here, is any entity in which all of the equity investors are accredited investors. So essentially, an entity would be like a business. And within the business, the people within that business would have to be something called accredited investors. So who are accredited investors? So accredited investors means either, there's a couple of definitions here. One, you have a personal net worth of $1 million or more, and this actually excludes your primary residence. So not your primary residence. So if you have, for example, a house that's an investment property, that would be included into the personal net worth, but not your personal home. It could be an executive or a partner, director, or other qualified person tied to the hedge fund itself. So that would be allowed. So if you were like part of the hedge fund, you could invest in the hedge fund. You could have a personal income of $200,000 or more per year if you're individually filing taxes. I believe it has to be $300,000 or more if you're married filing jointly. Double check that because these numbers change sometimes, but I believe that's the number. And it could also be an employee benefit plan or a trust fund. So again, this is more on the institutional side, where you have like an entity investing with a net worth of $5 million or more. Now, recently, the definition of accredited investors has also changed to include investors that have, or people that have licenses, right? So we're talking, I don't know if I spelled that wrong. I don't think I spelled that right, but these are people that have, for example, I think through FINRA, they have like maybe a Series 63 license or whatnot. And if they did the research and if they did the education and studying, the idea is if you're selling these these funds, these investments to your clients, you should probably be able to invest in it yourself, because ideally, in theory at least, you should have the knowledge of what goes into the fund, right? So that's typically who can invest in hedge funds. If you feel like you belong to these, or if you want to learn more, make sure you keep watching. And I also wanted to share again, if you want to learn more about all of this, make sure you check out my newsletter, which is in the link in the description below. So moving on, we talked about fees, right? So hedge funds have fees. And I wanted to show you an example of if you invested $1 million in hedge funds, there's something called a 2 and 20 rule. The 2 and 20 rule is all to do with fees. So in reality, you might be looking at about 22% in fees. Now, this is a little bit outdated. Some hedge funds have actually lowered their fees, but this is generally the type of rule that we would be looking at as investors, 2 and 20. So the 2% is essentially every year, regardless if the fund makes a profit or it makes a loss, you are paying 2%. So the expense ratio here would be 2%, right? Or 200 basis points. So that's pretty high, because most ETFs, for example, are like 0.03%. That's the expense ratio, or 3 basis points. So as you can see, there's a pretty big difference between 3 basis points and 200 basis points. So you're already paying a premium for that to the hedge fund. The second thing is, if there is a profit, if there is any type of profit in any given year, then you're actually paying 20% of the profit to the hedge fund. Now, the goal of this particular number is essentially trying to show that the hedge fund is in the same boat as you, which would try to incentivize the hedge fund to perform well, right? So they're trying to incentivize their people, their analysts, to find the best possible investments, because if they find good investments, then you, the investor, would pay them 20% of the profit, right? So if you made $100, you would be paying $20 just for the profit. Like if you made $100 in profit, you would be paying $20 of that profit to them. And out of everything, out of your entire money that you gave to them, like if it was $1,000, you would be paying 2%, including the profit. So 2% per year of the investment, regardless if there is a profit or not. So that's kind of the fee structure of hedge funds. So there's different types of hedge fund strategies too. These ones I thought were pretty comprehensive. We got 5 without going into the details. Equity is literally stocks. So we're looking at the stock market in general. Event driven. So like I was saying, if there's geopolitical issues or whatnot, then that event, geopolitical tension, might be the trigger for the hedge fund to actually open up a fund and invest in a way to like hedge that event. Macro is like pretty large level. So we're looking like across the world, international. We're looking, commodities, currencies. So this macro typically has to do with what countries are doing with each other or not doing with each other. Tariffs might be one there. Relative value. So this is generally more conservative. So we're looking at bonds, for example, fixed incomes. This is a little bit more conservative. And then fund of funds, this here is also conservative. So this is a little bit more strategic conservative investment with bonds, possibly, right? So it's a little bit more diversified, but you're still paying the 2 + 20 fee rule. So guidelines to picking a hedge fund. If you're interested in this, I thought these 6 guidelines would be interesting. So first, 5-year annualized returns. You want to understand, how is this hedge fund returned over the last 5 years? Because there's some years where it could be massively up, and then other years where it could be massively down. You want to take a step back and look at the bigger picture. This thing here is called the alpha, okay? So the alpha is essentially how much is it outperforming a certain benchmark, right? So is it outperforming the S&P 500 by like 50% or etc. The standard deviation is another thing that I would want to be looking at. Standard deviation essentially looks at the volatility, right? So the higher the standard deviation, the more volatile it is. And then you just have to ask yourself, are you willing to stomach massive highs and massive lows? Are you able to put away that money and like not need it for the next 5 to 10 years or whatever the lockup period is of the hedge fund? Because hedge funds can sometimes be locked up for 5 to 10 years, if not longer. So it just depends on the actual terms of the fund. Months to recovery, maximum drawdown, like how much can you be willing to lose? Fund size and firm size. Do you want to invest with a small hedge fund or a big hedge fund? I chose in my examples here one big one and then a medium one and a small one. Minimum investment, sometimes they require a million, sometimes only 100,000 or less. And then redemption term. So this just means how long is the lockup period. And then also it asks about if the lockup period, let's say, is 10 years, okay, then if you need to take your money out after year one, then how much of your money do you actually get back? Typically, you only get back like 30%. It's typically 30% or 30% of your money is what you would be getting back. And so, if you put in $100,000 and after 1 year, you're like, nope, I need my money for whatever reason, you might only get back $30,000. So that's something you also need to think about. So this is called the surrender charge. Or some people might call it the redemption charge or the lockup charge. So a couple of pros and cons, like why would you even invest in a hedge fund in the first place? It could certainly generate positive returns in good or bad environments, and it could certainly outperform the S&P 500. They have certainly in the past. It can reduce overall portfolio risk. So again, this has to do with the word hedge. It reduces the risk. Investors can customize the investment strategy. That's because hedge funds have a lot of that ability to customize. And then you can access some of the world's most talented investment managers. Again, hedge funds really do employ top talent in terms of intelligence, in terms of accomplishments, and you are paying a fee for that though, as well. Don't forget that. There is concentrated investment strategy. It can expose hedge funds to gigantic losses. I'm sure you've heard during 2020, there have been several hedge funds in the news that were targeted through some Reddit groups, and they did make some losses. Use of leverage can turn, so leverage meaning debt, can turn what would have been a minor loss into a significant loss. So hedge funds can be quite volatile that way. And then you do have to lock up your money, which can be a pretty big downside if you don't need it, or if you do need the money at some point. So Trump era regulatory update, I did think I should include this because there have been a lot of regulation changes that do impact hedge funds. So for example, from January to June 2025, in early 2025, I believe this was late January or early February, the Trump appointed SEC chair, Uyeda, essentially started rolling back 14 Biden era rule proposals. And then that was further confirmed, I believe, on June 12th or early June, where you had the SEC and CFTC delay new private reporting rules to October 1st, which means that there's no necessary disclosure yet for hedge funds, for example. And then I have this article here, early June. Is where we can see it. So the Commodity Futures Trading Commission and the Securities and Exchange Commission, they both allowed that for October, and it might be delayed even further, which again shows that there's this deregulation going on, which could actually help hedge funds and potentially their hedge fund investors. It might also hurt them though. So deregulation emphasis via extended compliance deadlines and other means, it can help hedge funds, right? But it also means less transparency. It means less oversight, which is what we were talking about. There's still a pretty high barrier to entry. It's not lowering like the buy-in cost for the regular person, and the environment in general with the deregulation is just more hedge fund friendly because of that less transparency. So a couple of the hedge funds that I would be looking into is Citadel. You guys might have heard of it. Citadel is one of the second largest, $340 billion of assets under management. Here you can see Citadel compared to Millennium, which according to this chart at least is the largest one at almost 400 billion. Citadel has several funds, some of them specialize in commodities, credit and convertibles, equities, fixed income, and then global quant strategies. These are some of the strategies we actually spoke about earlier, so you can just see this actually in action with Citadel. The fund this here shows you a couple of funds that Citadel actually has. I believe Wellington Fund, I want to say, is pretty popular. It's kind of like a standard, and you can see that it actually hasn't performed that well in the first quarter of 2005. Actually, I thought this said 2025, so sorry about that. But the point is, regardless of the year, you can see that it's been quite volatile regardless of hedge fund that you're looking at, right? One is up 22%, one is down -2%. and it's the same quarter. So they can be quite volatile. This year is a little bit more up to date. This is Q1 of 2025, and you can see the S&P 500 in blue versus Citadel in red, and you can see that Citadel has outperformed the S&P 500, but there's also times like here where the S&P 500 clearly outperformed Citadel. So it's, again, just a risk you might have to take. And this isn't even including the fees that you would have to pay to Citadel. So, something to think about, but it's good to know. So overall, Citadel, it's an absolute powerhouse. It has many strategies. The Wellington Fund, it is kind of that flagship fund, and it has returned about 15% in 2024. So not bad. The stock market on average returns 9 to 10%, right? So this is slightly above, but again, you're also paying 22% roughly, 2 and 20, right? That rule. So it's a lot of money. So what is the net return? It's probably less than the stock market itself, at least for that year. Renaissance Technologies is another one. So this is more tech-based, as the name suggests. This is a little bit less. It's slightly above 165 billion in AUM. The Medallion Fund is their flagship fund. Over 34 years, it's returned about 40% compound annual growth rate, which is not bad because, again, the stock market, we're looking at 9 to 10%. But overall, you can see here, financial crisis is when Medallion actually did really well. We're looking at 88% return, 100% return for the dot-com bubble. So it seems like the Medallion Fund is actually quite successful, especially during political or economic crises in the United States. So something to think about. Here's a table I thought I should show you from 1998 to 2018. And you can just see, again, the gross return. I wanted to show you the volatility as well, right? We're looking at 76%, 152%. Surprisingly, it's not, there's 1% return. I thought I would be seeing a negative return, but I haven't. So that's the gross return. Net return is after fees, and that's where we start seeing one negative return. And the fee we see here is fixed fee of 5%, performance fee of 20%. Yikes, right? So anyway, but still, it's doing pretty well. And the average is 66% return, 39% after fees. Not bad. Okay, so it's very quant heavy. Medallion Fund, flagship fund, outperformed consistently, about 40% pre-fees historically. It's not bad. Finally, the third one is Roos Capital. It's a little bit less known fund, but it's a macro fund, meaning, again, it's like very high level. The hedge fund for Roos Capital Management actually hasn't done that well, right? So we're looking at less than a 1% return for the year. This is as of March 7th, 2025, so the first quarter. Not doing that well. But still, if you're looking at the overall picture and you want to see, okay, what is Roos actually investing in? These people are spending 22% in a profitable year, 20 plus 2, the regular fees. You can go to this website, Fintel, and you can actually look what Roos is investing in, right? So you can see at the heat map of the top 100 holdings in their flagship fund. You can see Apple, Amazon, DFS, Microsoft, Meta, and so on. And you can see where the majority of their money is allocated. And you can actually get this on your own without paying the 2 plus 20 rule. And this is something that I thought was really cool. And I wanted to show this to you as well. So overall, it's a $22 billion fund in AUM. So it is a smaller size fund, which you could immediately tell. It has adaptive discretionary macro strategy, which means it changes depending on certain triggers or like different issues in the economy. And it really does thrive in Trump era volatility. So it takes advantage of the volatility. Of course, in this little snapshot here, the first quarter, not so much, but hey, you never know. So I did want to show this to you, though. I wanted to show you a big, a medium, and a smaller size fund. So I like it because it does have diversification, it does hedge risk, and it explores proxies, meaning you can look at funds that are somewhat related to this fund, but don't cost that much. And I do think it's important to know this one exists. I don't know if I would invest in it just based on the quarter one results, but again, it's important to look at the macro level, like the bigger picture level, last 5-year rolling returns. So most important thing is make sure you start building wealth now with or without a hedge fund. Even if it's not with a hedge fund, check out what they invest in, check out what their previous overall returns are, like the Medallion Fund. And then if you like what you see, then maybe just try to figure out and select those investments on your own without needing to pay the 2 and 20 rule. And you can get ETFs or individual stocks that somewhat proxy or mirror those hedge funds. And you can get decent returns if you're willing to put in some sort of risk, right? Remember, it's a hedge, so you got to take some risk in order to get a potential return. Most important thing though is start now. That is absolute key. So if you enjoyed this video and you learned something new, please like and share to help others. Subscribe to my YouTube channel, which is at _MMW for more cool insights. And then make sure you check my newsletter, which is in the description below for more exclusive tips and tricks. Your bank accounts will thank you later. Thanks, guys.